For consumers, a lower oil price is good. For economies dependent on the resource, it's quite serious news. The Saudis have said they're anticipating oil lower for longer. Brilliant for us, lousy for you, however, if you're a Sasol shareholder. This is Tonight. I'm Bruce Whitfield. Tonight I'm joined by Dr Jeremy Wakeford. He's chair of the Association for the Study of Peak Oil South Africa, to find out just how low it can go. Jeremy is an economist. He works with the Stellenbosch University, but also looks very closely at the oil market. And we have seen, Jeremy Wakeford, in recent weeks, the oil price plunge from close to 110 not so long ago to below $90 a barrel. What dynamics are playing out right now?
Good evening, Bruce. Well, clearly there are a lot of factors at play at the moment. We've seen the steep decline in prices, and it's never one factor that can contribute to such a marked decline in prices. So we've got demand-side factors, we've got supply-side issues, and then throw into the mix some geopolitics, as well as the dollar strengthening in the last couple of months. So we could unpack some of those factors. Starting on the demand side, perhaps we're seeing that the global economy is really a bit sluggish at the moment. Concerns particularly about the Eurozone, possibly even slipping into recession again next year. China's economy is not as hot as it was last year, perhaps, and in preceding years. And the IMF, of course, has just recently downgraded its forecast for economic growth for the world, both for this year and for next year. Added to that, on the demand side, we're also seeing that some of the Asian countries have been cutting some of their fuel subsidies, and this, of course, is also contributing towards a decline in demand for fuels in those countries.
Demand is the one side of this equation. Of course, it's an absolutely crucial side of this equation. If there's no demand, then of course prices will fall. But what has happened in the past is when we've seen uncertainty in oil-producing areas, traditional oil-producing areas like the Middle East, we've seen prices spike upward. We haven't had the Middle East, traditional oil-producing areas, quite as unstable as we're seeing in recent months as we have probably since the second invasion of Iraq by Allied forces. What is the situation there in terms of production?
Well, despite the increased conflict in Iraq and Syria in recent months with the spread of the Islamic State insurgency, the actual production rates have been fairly consistent. So in Iraq in particular, most of the oil production comes in the southern part of the country, which thus far has been relatively free of the conflict. It certainly has been beyond the reach of the IS. Production is shut in parts of the northern area of the country, although the Kurdish region is still pumping out about 250, 300,000 barrels a day. And so overall, Iraq is still managing to produce a bit more than 3 million barrels a day. And other countries in the region are still producing their sort of normal amounts. And in fact, OPEC reported recently that the group as a whole had increased its output by about 400,000 barrels a day in September. So on that supply side then of the market, one's still seeing ample supplies relative to demand. And of course, that's also backed up by rising production in the United States. They're on track to add about 1 million barrels per day of new capacity, mainly from shale oil in North Dakota and Texas.
What is it exactly that they're producing? Because we're hearing about the gas revolution, of course, which Sasol wants to capitalize on in the southern states of the United States. But then there's shale oil, which is coming through as well. This is like Dallas replayed once again, 2014 style, or not?
Yes, well, certainly Texas has undergone something of a renaissance in its oil production in the last few years, and then North Dakota has just emerged onto the oil production map. And shale oil is really a corollary to the shale gas. It uses essentially similar kinds of technologies, in particular the hydraulic fracturing with the injection of large amounts of water and sand and fracking fluids in order to access small deposits of oil that are trapped within shale rock layers. And really the main reason that we've only seen this come on stream in the last few years is that prices weren't high enough to support that kind of activity, the intensity of the drilling that has to take place in order to liberate the shale oil.
And that creates a different dynamic, doesn't it? Because suddenly oil at 110 makes shale oil viable. Is oil under $90 a barrel, does it make shale oil as viable?
Well, it certainly brings it into question. And I saw a report from Deutsche Bank suggesting that below about $80 a barrel, about 40% of US shale oil would be uneconomic. Conventional wisdom is the cost of production does vary from area to area depending on how concentrated the resource is underground. But certainly the more marginal production areas will be looking at probably scaling back the rate of drilling with prices under $90 a barrel. And so I would see something of a cost side floor underneath the oil price, which will begin to kick in over, I would say, the next few months.
So where does oil go to from here then? I mean, we've seen unexpectedly low oil prices, which is great to see as a South African consumer of the stuff. It's got to be good for our current account as well as oil costs us less to import. I think overall we're down about 8 or 9% in terms of the fuel price component of oil that goes into our tanks. How low can oil go?
Well, that's the million-dollar question, and I don't make a habit of trying to forecast oil prices because there's so many complexities involved. I mean, it depends, again, on several factors. I think one of the major ones is whether OPEC decides to cut production. They're due to meet on the 27th of November, and already analysts and market operators are waiting with bated breath for their decision. Traditionally, in the past, Saudi Arabia, as the world swing producer, has cut production when prices go below their sort of target level, and over the last year or so they have said on a few occasions that they regard $100 a barrel as a fair price. And in fact, many of the OPEC nations struggle to balance their government budgets with oil prices below three figures. So I would expect to see some action, although paradoxically, perhaps just recently we've seen something of a mini price war perhaps between Saudi Arabia and Iran, with them saying to the markets they'll be cutting prices for some of their supply. So somewhat mixed signals at the moment from OPEC. But again, I would really expect that over the sort of medium term, the next 6 to 12 months, if prices remain at this level, then I would expect some cut in supply from OPEC. However, if the world economy continues to stagnate and for the markets to really get rattled, then certainly prices could drop some more in the shorter term. Well, in the long term,
when one looks at oil as a key commodity when it comes in certainly to inflation, the outlook for inflation in South Africa has got to improve quite significantly then if the oil price at least has a lid kept on it. What does it do, though, to the economics of exploiting the Karoo? We've got natural gas, we believe, trapped in the layers underneath the Karoo. There's an economic opportunity for South Africa there, but there's only an economic opportunity if the rest of the world's energy complex remains at quite a high level. Where does that break down in terms of the Karoo opportunity for South Africa?
Yeah, well, of course, there are many unknown factors about the potential for shale gas, one of which is the size of the resource base, and the other one is how the cost of production would look. And, in the US, you're seeing the price of natural gas being very low. And, in fact, a lot of the producers there are struggling to actually make profits with prices around $4 per million BTUs. In South Africa, though, the cost of production would be considerably higher because we simply don't have the kind of infrastructure to support the shale gas development. It'll take time to build up that infrastructure, whereas in the US they had it readily available. Also, there are questions around the geology and how easy it's going to be to tap any natural gas that might be there. It's believed to be very far underground. And so I think that, the environment will obviously, the general energy price environment will affect the decisions of the energy companies that are exploring or in the initial stages of exploration for shale gas. But gas is somewhat disconnected from the global market, except via liquefied natural gas, which probably wouldn't really come into the picture in the medium term in South Africa. So even if oil prices are lower, there might still be a case to be made for the exploration on economic grounds.
And one looks then at the global oil environment. When I was growing up as a kid a while back, we were under the impression that we would run out of oil by now. What does the global oil picture look like in terms of energy demand versus the potential supply?
Yeah, well, of course, the markets at the moment are telling us that supply is ample. In fact, relative to demand, there might even be a bit of a glut at the moment. But over the long time, we know that oil is a finite resource. and it's being depleted year by year as we extract and burn it. And at some point in time, it's inevitable that we will reach a maximum rate of production. Reserves will be depleted to the extent that we can't meet increasing demand from year to year, and that will probably push prices up considerably. And in fact, if we look at conventional oil, which excludes things like the shale oil that we've been talking about in the US and the Canadian tar sands, the conventional oil has been pretty much on a plateau since about 2005. The conventional oil fields that are in production already, existing fields past their peak of production, are declining at a rate of about 6% a year, according to the International Energy Agency. So this means that every few years, the world has to bring into production new oil fields equivalent in size to what Saudi Arabia is producing today, so every 4 to 5 years. So this is an enormous task, and certainly in the last few years, the United States has been up to the challenge tapping into the shale oil. But the International Energy Agency is forecasting that shale oil will probably itself peak and plateau by about 2020. And some other independent geologists who've been crunching all the numbers from the oil fields are even less bullish about shale oil and suggesting that perhaps within about 2 or 3 years or so it might peak and then start a fairly rapid decline. Because the individual oil wells in the shale oil area really have very rapid decline rates. You're looking at about 80 to 90% depletion of individual wells within the first 2 or 3 years of production.
Dr. Jeremy Wakeford in Cape Town, thank you very much. He's chair of the Association for the Study of Peak Oil South Africa, giving us perspective not only on global supplies, but also on the pricing pressure on the commodity right now. Long may it last. Thank you for watching. There'll be more tonight, tomorrow. Until then, good night and goodbye.